Welcome to Let Me Fix This. Enjoy the video.
In this video, I will explain how to play call and put options. Options are financial contracts that give you the right, but not the obligation, to buy or sell an underlying asset at a predetermined price on or before a specific date. We'll explore call options, which grant the right to buy, and put options, which grant the right to sell. Understanding these can open up new strategies for your investment portfolio, offering flexibility and potential for profit in various market conditions. A call option grants you the right to purchase 100 shares of an underlying stock at a set price, called the strike price, before the expiration date. Investors typically buy call options when they anticipate the stock's price will increase significantly. If the stock rises above the strike price plus the premium paid, you can profit. However, if the stock does not move as expected, your maximum loss is limited to the premium you paid for the option contract. Conversely, a put option provides the right to sell 100 shares of an underlying stock at a specified strike price before its expiration. Traders usually purchase put options when they believe the stock's price will decline. If the stock falls below the strike price minus the premium, you can make a profit. Similar to calls, your risk is capped at the premium you paid for the put option, offering a defined maximum loss. When trading options, remember they have a finite life and expire. This means their value can decrease over time, a concept known as time decay. It's crucial to understand implied volatility, which impacts option prices. Always manage your risk carefully, never invest more than you are comfortable losing. Consider starting with small positions and thoroughly researching before making any trades to protect your capital.
Thanks for watching. If you found this helpful, don't forget to like and subscribe.